with the Daily Market Report coming to you midday, Tuesday, January 29th. And I'm going to show you a little give you a little introduction to WD Gann's short-term cycles and how you use them to anticipate turning points. The current rally is due primarily to the configuration of the 180-degree cycle. Let's take a look and see what I mean. Here's a daily chart of the S&P from, I'm going to pull this back to get the January high in from last year, and you can see how the rally started. The blow-off part of the rally started from late December. So that's what I want to concentrate on. Let's zero in on that. Okay. So what you need to know right now, and why we're pulling back here, or at least we're backing and filling, is that we are 360 degrees from the late January blowout top. Let me preface this by saying that the legendary trader W.D. Gann said time is more important than price, and keyed off the natural cycles of the geometric divisions of the year. These are the 90, 180, and 360 degrees day cycles. These also are the 120 and 240 degree day cycles. So let's take a look at why a turning point is due here, right where we are. We are 360 degrees days from the late January blowout top in 2018, right here. We are 180 days from the September-October all-time high, right here. This was September 21st, and this was the October 3rd test failure high. So you split the difference, you're basically at September 29th, and 120 days from that turning point is where we are right now. We are also 90 days from the big October 29th low right here. Likewise, a knowledge of these cycles would have put you in a position to look for the selling climax that we had in late December. Late December, why is that? Late December, right here, let's zoom in on that. Late December was 180 degrees from the June, actually I want to show that, from the June 29th, 2018 low. Now we know that that was an important pivot because it perpetuated a virtually uninterrupted rally to the all-time high in September. So that underscores the significance of the April turning point. So again, late December was 180 degrees from that June 29th low, and that was the time to look for a potential turning point. Likewise, late December was 90 days from the September all-time high, right up here in this region. Late December was also 360 days from the start of the blowout rally in December. This is the end of December 2017, and so here we were 360 degrees from here. So when you get a cluster of these turning points, the likelihood is that you're going to get when you get a cluster of these cycles coming together, I should say, the likelihood is that you're going to get a turning point, especially when you get a confirmation in price. There are let's go to the hourlies and see what the pattern is that suggests such a turning point. There are three things that indicate such a turning point is on the radar. First, the S&P hourlies show they have snapped a rising wedge coming up from the December 26th low. That's this pattern right here. It's a rising wedge. Secondly, there are two island tops here and here. These two island tops over the last week or so of trading. And as well, you have a test of the January 18th, that's right here, the January 18th, 2675 high for the move. Pulling back the lens shows the significance of that 2675 high. It was not happenstance. If you look at this trend line here, if you extend a trend line connecting the important October 29th low and the late November low, and you extend it, which is what I call a live angle, that live angle completely precisely catches the January 18th 2675 high. So you notice the importance of this trend line is seen where you break it in early December, rallies back up, looks like it's recovered, but then the second mouse gets the cheese for the bears when it breaks that trend line again with authority. And notice that little breakaway gap right there that was a blaring alarm that we were headed lower. So this pattern here is what I call the first mouse gets the squeeze. So this first sell signal, this first break of this trend line got the squeeze, and the second mouse, the second move below the trend line, got the cheese for the bear move. Drilling down into the hourlies a little further here, you can see that we have three tests. And this is the current picture right now in real time. We have three tests of the 50-hour moving average, which is this blue line here. And it's doing a dance at the 50-hour MA. And interestingly, this also ties to the 50-day moving average, as well as a 50% retrace, or the midpoint of the entire bear leg down from September through late December. And that ties into 2644, right where the index closed yesterday. So the next pullback is going to give us a lot of information as to whether a counter trend rally is complete or whether it will play out in two steps, an ABC pattern with another leg up being the C wave after a presumed B wave pullback. In other words, an A wave up off the lows, a B wave pullback, and then a possible C wave. But remember, the next pullback is going to determine whether we have completely finished this counter trend rally or whether it's going to play out in two steps. We may continue to trade sideways today within this range, but I think Apple's earnings after the bell and with the Fed speaking tomorrow should see this triangle, this sideways pattern resolve. We could get a first pop, we could get an initial pop up to a marginal new high. I'll believe it when I see it, and only if this gap is offset will that occur, and that's at around 2660. Otherwise, a break of support here, which ties to yesterday's lows around 2630ish, will trigger a rule of 4 sell signal. That's a break below these this 3-point trend line. So that's it for now. With that, I have to let you go. I'll see you back here tomorrow. Appreciate your time. Thanks for listening. Good luck trading for the rest of the day.